Hey, good morning, it's Owen, Bigland. This is the Inside Edge video blog. I've had a lot of emails from people wanting me to do some more update or more video blogs on investing and the psychology behind successful investors. So I always like to tie the investing thing in with real estate because after all, I am a realtor, so they all are intertwined in my opinion. But this time I'm going to channel the great Warren Buffett and talk about the difference between a speculator and an investor and how far apart they are. Now, I'm an investor. I've talked about it before. Investors buy good homes, quality rental properties, buy good quality dividend-paying stocks, and they don't do much with them. They don't fiddle with it. They buy it and they leave it and let time and compounding do its thing. So when it comes to investing, if you read any of Warren Buffett's books, he'll talk about, and I follow the same philosophy, I only buy high-quality companies that have got massive amounts of free cash flow. They're profitable. They're money machines, essentially. And they've got wide competitive moats. And what a wide competitive moat means is that it would be very difficult for a competitor to come in and take market share. So in other words, for me to come up with a new toothpaste, it would be very difficult for me to develop a toothpaste and get it in stores and try and compete with Colgate. It's just not going to happen. Or invent a new type of soda and compete with Coca-Cola or Pepsi. They've got two large big economies of scale. It just would be very difficult to crack those markets. So for that reason, these companies are just money-generating machines. As Warren Buffett says, you know, companies like Procter & Gamble, Johnson & Johnson, Hershey, Bristol Myers, Pepsi, Coke, Kraft, Diageo, Brown-Forman. These companies are just McDonald's. These are just money-generating machines with competitive moats and a lot of free cash flow. He used to say that a ham sandwich could run these companies, and he's right. Pretty tough to screw up the business models that these companies have got. Take, for instance, a company like Nestle. They've been around for over 100 years. You're not going to. It's very difficult for a new competitor to break into the fields, the packaged goods and the consumer products that Nestle is dominant in. So for that reason, they produce massive amounts of free cash flow, and they distribute a good percentage out in the form of dividends. Dividends, think of it as a share of the profits. And most of these companies that I just named have been paying dividends. And even better, they've increased their dividends consistently over the last 30, 40, 50 years without missing a beat. Those are the type of companies you want to own. You don't want to own companies like Twitter or Tesla. Tesla might make a fantastic car, but the company isn't profitable yet. Why would you invest in a company that's not making any money and really has no chance of making any money for at least another 10 years or so? Very risky. So I only invest in companies that are mature, that are cash flow machines. That's what an investor buys. Or another term that Warren Buffett used to use is that I buy stocks that if I bought them today and they closed the New York Stock Exchange tomorrow and didn't reopen it for 10 years, I would not lose one night of sleep. And that, you should always abide by that philosophy. I do. When I buy companies like Nestle and Colgate and Coca-Cola and Johnson & Johnson, I know that if they closed the stock market 10 years from now and reopened it, I know that stock would be worth far more than it is today, and I'm going to continue to get those quarterly dividend payments without any problem. They would really have to screw things up to ruin that cash flow model. Now, a speculator, on the other hand, speculators, they trade in and out of stock. They're not interested in long-term value or dividends. They'll buy a stock, hang on to it for a day or two or a week, and then try and sell it at a profit. Now, there are some speculators out there that make money. Very few. The odds are stacked against you. I think you'd be better off going to Vegas and probably betting on roulette. You'd probably have a better chance of making money. I laugh when I watch BNN Network. If you watch that network, they'll have some commercials for a couple of different companies. I won't name them, but these are online brokerages, trading accounts that you can open. And the first couple times I saw the commercial, I thought it was an online poker commercial. These guys are all excited and their faces are lighting up looking at their stock portfolio. Well, any of the best hedge fund managers or Warren Buffett or private equity managers will tell you, the successful ones, Investing should never excite you. These guys look like they're playing poker. That is not investing. That is playing poker. That's gambling is what that is. So you want to stay away from that for sure. So the same thing though when it comes to real estate. I always tie it back into real estate. You want to have the investor mindset there. You want to buy a house, do your due diligence, get a good realtor, do your homework on it, buy it, live in it for 8 to 10, 15 years, and you are going to do fantastic on it. If they bought the house and they closed the MLS for 10 years and you couldn't sell it, you still feel fine about it and you're not going to lose a night of sleep. That's the way, the mentality you need to have if you're buying any type of real estate, whether it's your principal residence or it's an investment property. Just let time compounding do all the heavy lifting, and that's all you need to know here. This is what I've tried to pound home so much in my blog here over the last 4 or 5 years. This blog is really about the mindset you need to create wealth, whether it's through stocks, equities, real estate, whatever. The mindset is just buy it right. Don't just buy anything. Do your due diligence, buy it, and then just let it be. Don't fiddle with it. As the founder of Vanguard, Jack Bogle, says, too many people think they have to be doing something all the time when you don't. Buy your house, live in it, enjoy it. Time and compounding and capital gains will do all the heavy lifting for you. Trust me. I'm Owen Bigland. As always, thanks for watching. I'll see you next time.